Hello and welcome to Pro Trader Strategies Market Commentary for Thursday, December the 6th. My name's Eric Wilkinson, and some of you may recognize me as the Wolfman from CNBC, Fox Business, or even the Wall Street Journal for my commentary on everything from economic to geopolitical and market analysis. Please keep in mind that everything that we talk about in these market commentaries is not a solicitation to buy or sell any of these securities or strategies. At the end of the day, I'm here to teach you some different strategies you can then implement into your portfolios, but please do that in your own way. Also, remember the past performance of any trading system or methodology is not necessarily indicative of future results. All right, having that out of the way, let's get it on with some economic data. We didn't have anything really going on yesterday with the President Bush's funeral. The market was closed, and basically the earnings that were supposed to be released yesterday are being released today and some other days. So we have to catch up with all of that. But let's talk about the economic data from today that we got. So here in the United States, we got ADP non-farm payroll came in at 179,000, expected to be 190,000. So what this is saying is that not as many people were being hired as was expected. Now, this isn't a really important economic data point. People are going to be more inclined to look at tomorrow's data point for Unemployment Friday, which is the non-farm payrolls there. This is a bit of a precursor to that. So take it for what it's worth. And then here we got, the revised non-farm productivity came in at 2.3%, expected to be 2.3%. And then the labor cost came in lower than expected at 0.9%, expected to be 1.2%. So productivity is keeping at pace, but the labor costs are going down, which is not a good thing for an economy that we'd like to see to be expanding. So we'd like to see those labor costs go up a little bit. That means there's some wage inflation there to kind of counteract other inflation. Not really seeing that right now. And then unemployment claims came in at 231,000, expected to be 229,000. So higher than expected there means more people claiming. I don't think that big of a red flag right now heading into a holiday season. I think that people are going to be looking for jobs in order to buy some presents to put under the tree, right? All right. And then we got in the United States, our PMI, Purchasing Managers Index, through the ISM, which is the most important one to look at here in the United States. The Institute for Supply Management. Anything above 50 is expansion in the economy. Anything below 50 is contraction. So we were expected to see a 59.1, came in at 60.7. Better than expected there is good. Factory orders came in at a negative 2.1%, expected to be a negative 1.9%. We'd expect that number heading into a holiday season to be a little bit higher, and they revised last month's number down quite a bit from a positive 0.7% to a 0.2%. So a big cut there on the revision. That factory orders number not looking very great, and making probably even people like me that were thinking that we were kind of overdone to the downside. We don't want to see too many economic data points like that, especially in a holiday season. So that's something to be a little bit concerned about. And then we just now got out the crude oil inventories. They came in at a negative 7.3 million barrels, expected to be a drawdown of 1.3 million barrels. That is going to be pretty bullish for crude oil, right? We have a much bigger drawdown than expected by over 6 million barrels. That should drive the price higher, as that shows demand on the oil front. So would expect maybe that whole $40 a barrel to be held off a little bit longer, as some people were calling that. With the OPEC, that's the real thing to be looking here. That's the gear that is going to be really making this market move. If OPEC starts breaking up, that could really send the markets lower, as those guys would expect to increase their output and not stick with their quotas. So we're going to have to keep an eye on that as well. Anything below 50 makes it difficult for us here in the United States to produce the oil through the fracking operations. So all of those things are very much at the forefront of what we would be doing, looking at when we're trading crude oil. I'm staying away from it right now. I'm trying to get all exposure out of oil just because there's too many variables going on right now in and around that commodity in order to really start taking a stab at directionality. But right now we can see crude oil is getting a lift off the lows as we're sitting here talking because of that drop in inventories. Lack of supply should drive higher or should drive the pricing higher. Sorry about this little thing going on up here in this little array. I don't know where that array came from. I didn't put it in here, and it's on every one of my charts. If you know how to get rid of that, let me know. I don't even know exactly what it's telling me, to be quite honest, except for look at this chart. All right, so gold moving higher. We would expect Bitcoin in this type of environment to start getting some love to the upside. We're not seeing that like we're seeing here in gold. You know, that's the safety aspect. We're seeing it in bonds. We're seeing it in gold. We should be seeing it in Bitcoin if it is a true safe haven or, you know, a place to park your money. And it's not happening today. As you can see, it's down and creating a new low. It's going the opposite direction if it is going to be something that is considered a safe haven to park your money when the equities are not doing well. It's just not showing up there. You can see here with the VIX, we got a spike up into the 25s earlier today. That is based on the opening much lower than what we were expecting. That's going to drive volatility higher as people come in to try and protect their positions. And we'll see that showing up here in the bonds and across the board. The levers and pulleys of the markets are really working. Maybe not so much over there in crude oil. Hasn't really gotten the indication as to the big drop down right now. We were right on top of that this time. But you can see that bonds have moved back to the point of control where the most time and volume has been spent over the last 52 weeks. This might be getting a little overdone to the upside as this yield curve inversion really is signaling to the Fed to hold off. I'm starting to actually see a couple of Fed governors talk about just that maybe they need to change their progression of increasing interest rates, at least in the near term. So that is finally coming into the forefront of what they're looking at. All of a sudden, all of the markets have told them, like time and time again, that it's time to pause. I think they're finally looking at the yield curve and saying, yeah, you know, the markets are really trying to tell us something here. So bonds moving higher. Higher bonds means lower interest rates. And when the bonds have lower interest rates in the front, that's when we have that yield curve inversion, right? Which means that interest rates are higher right now than they are down the road. And if that means higher interest rates here than down the road, that means that they need to start lowering interest rates, right? So that is the market telling the Fed, yeah, you guys have probably overstayed your welcome and overdid it once again. We used to have a stat on the floor that used to be, I think it was 100% of the time, the Fed overdoes it and the next move has to be an ease. Now, that's a pretty easy scenario, right? If you constantly are raising interest rates, well, when you've overdone it, you have to go the opposite way. So it seems like one of those weird statistics that you can make a statistic say anything you want. And in that case, that is one of them, is the Fed always overdoes it, whether it's increasing interest rates or lowering interest rates. So looks like they've overdone it to the upside on raising interest rates. All right, let's move on to the rest of the equities. We've got the NASDAQ right here. Sorry, I got the VIX out of order with the bonds there. And we've got my little array popping back and forth again. We've got the NASDAQ down over 100 points. It was down almost 200 points earlier this morning, right off the open. We're starting to see a little bit of a lift. I think that people are starting to come and find value on certain stocks and taking advantage of this oversold situation. Now, this is what I've been talking about, you guys, for weeks now, that it's going to pop back and forth pretty violently in and around this point of control as the market really tries to figure out what direction it wants to go in. I'm leaning towards the upside. I am long deltas in my portfolio. Yes, this does hurt today, but I've added those short deltas when we went to the extreme high, remember? Now I'm going to be looking to take some of those short deltas off and adding some more long deltas. I'm going to start playing this until it's basically breaks below maybe, let's say, this level here, which is just below the value area low. I don't even know if I'm going to get out right there. I probably would wait to see if it breaks below something like this Fibonacci extension low and lining up with the 50 Fibonacci for the last 3 years. So that being said, I'm going to hold on to this and see how it goes. I'm going to start playing this just like I've talked about when it hits those extremes. I don't think it's really going to go anywhere, and my market assumption hasn't changed. All right, so we can look at the daily chart of the E-mini S&Ps. It seems like all my charts are slightly out of order here. So the E-mini S&Ps, as you can see, they're kind of dragging on, lagging on the upward move here that we've seen on the rest of them. But like I said, we've seen three tops here. You know, usually we say 3 times through, but I don't think we're necessarily going to see that right now. It might break below this here, but I think, again, it's going to have a tendency to pop back and forth until we start settling down here in and around the point of control, and or we see something major really kick this out of whack. You know, a lot of this move has been on the China trade war rhetoric going back and forth between Trump and China. You know, that's driving volatility, but I don't think that the economy is showing that we are really in dire straits or looking at a recession here at all. I think that the fact of the matter is the market's just trying to shake out the weak hands, which is what we're seeing. All right. And the crazy array happens even more dramatically in the daily chart of the E-mini S&Ps, each one of these candles being a 30-minute. Each of the blue is a day, and this array, I don't know what it's telling me. Okay, we can see we're on the lows of the day here in the E-mini S&Ps. I really don't see a sustained bearishness throughout the rest of, you know, the month of December. I think we're going to still see this bouncing back and forth. It's opportunity for us to take advantage of. We're getting volatility to spike again. That's when we take advantage of those type of situations. All right, so Caterpillar. This is the only trade that I've added, and I've taken advantage of it because you can see this big sell-off they had yesterday. And you remember on the big pop, I took advantage in Deere and got short some calls. Well, with this move today, I've decided I'm going to get short some puts in Caterpillar. It's a bit of a hedge, right? I'm short Deere futures from near their highs of at least the last couple of weeks, and now I'm getting long Caterpillar. So now those two should usually move in tandem with each other. I thought about building out a big or a big wide strangle in Deere, but I thought that this was probably a better way to create a strangle and decrease some of my risk by, you know, going into a different asset. So with Deere, I went into the January sold the 110 puts, which is below, as you can see, the 52-week low, a couple dollars by 3. And I collected $1.89 for that, or $1.86, sorry, for that trade. So puts me even below $1.10 by $2. So 108.11ish is about where my break even is. So 108.11 is where my break even is. So $4, $5 below where the 52-week low is. I don't think the economy is doing that bad. We just got that big spike in volatility, made it to 100% or 100 ID percent. As you can see, it's at very high. So great time to take advantage of premium selling opportunities. And that's about it. That's all I've done. I haven't taken anything off. I am looking at taking Deere off. It's a little bit better than 50% of my max profit. And a couple of Philip Morris is not quite at 50% of my max profit, but it is doing much better. And with this down move today, I'm looking to cover a couple of those. The one thing to note is with even a like dollar down move in Deere today, let's just take a look at Deere. We got an extra dollar down move here, but with that $1 negative in Deere, my trade has actually lost value. How does that happen? We've got a dollar down move. I'm directionally to the downside by selling calls in this way above where this high is in this last high. But I'm losing money just today. It's up value for the time that I've put this trade on. But I'm just saying from yesterday's settlement to today's trade, I'm losing money on a downward dollar move selling calls. Generally speaking, we would expect that to be almost an instant winner. But you can see here on the volatility, implied volatility, we've gotten it to rise quite a bit. That's counteracted the theta that I have and the directional move, the deltas that I have, the short deltas. The volatility increasing by a couple of percentage points has counteracted my deltas. We talk about that all the time. That's why it's important to sell premium in high volatile market or in high ID percent environments. That's what this is. We can't always know when the exact high is or when the exact low is. So that's something not to necessarily be concerned about. I got the directional move. Volatility is hurting me a little bit today. But if my market assumption being we're getting these wild gyrations and we're going to settle in and around the point of control, this is exactly what we're looking for that type of market assumption. All right. I'm sorry I got a little bit long-winded today. A lot to talk about after yesterday's off day. A lot of things going on in the market, so I wanted to make sure I tried to cover all the bases. And that's about it, other than if you can't take that, take it easy.